Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group, and welcome to another episode of InFocus. Today, I'm joined by Brian Durno, our Chief Investment Officer, and also our Portfolio Manager responsible for the consumer staples and healthcare sectors. Welcome, Brian.
Hi, Mike. Thanks for having me.
So let's dive into it. Let's start with consumer staples. What's in this? It's things like toothpaste. Great example, toothpaste. You always got to brush your teeth, right? And soap, got to stay clean no matter what's going on. South of the border, sorry, I couldn't help myself, but sometimes you just got to wash yourself off from all that. It's true. So let's talk about consumer staples. I think earnings season, you've listened pretty much to results coming in. How has the whole sector fared from a consumer staples perspective, and then our picks?
Sure. Yeah. And this is one of those sectors that we, tends to act very defensively because the demand for the products, as you mentioned, are inelastic. People buy them no matter what. So it's a good space to have given all the uncertainties out there in the marketplace. So the group of companies, I'll focus mostly on the U.S. where it's much, let's say, bigger and diversified in terms of the number of companies there. But for the quarter in Q4 that just ended, that has just been reported, pretty much all the companies, the growth rate in earnings was about 0.4% for the group. And so that was, the growth rates here, you're not really buying a lot of these consumer staples companies for huge amounts of growth compared to maybe some other areas. You're buying them for stability, but that 0.4% growth rate compares to the S&P that came in, probably around 10%-ish, give or take.
How did our picks do compared to the 0.4%?
We had pretty good results from the names, and we've got a pretty good diversified basket of consumer staples companies rather than just say like one particular subsector. Everything from grocery stores to consumer products, those kinds of things. And so our average growth rate for our group was about 1.5% for the quarter. Okay. So that did a little bit better than average there. And the average valuation of the companies that we own is a little bit cheaper than the group. Not materially so, but a little bit cheaper.
Yeah, let's go there. So business-wise, our picks, compared to the whole sector, doing relatively well. And talk to us about the markets. How have they been reacting to the sector?
Yeah, and the sector, I would say, generally because of this defensive characteristic in times that have been a little bit more volatile, this particular sector might tend to perform a little bit better than average. That's very, very short term. And we tend to take a longer term view on owning these kinds of companies. And maybe I'll give you a couple of stats on why these candidates are such good, sort of, let's say, long-term buy and holds. The average ROE for these companies, so the return on equity, let's say a measure of the profitability of these companies, hovers around 24-25%. Some of them as high as 30%. So they're, let's say, very profitable companies. They earn a lot more than their cost of capital. Yeah. Right. And you can actually see that too in their dividend yield. Right. 2.5% roughly from our core picks. And because they're profitable, they can tend to increase their dividends with that profitability. And so the dividends have grown in this space over the last 5 years from our picks, around 5.2%.
Nice. Let's shift to healthcare. Talk to us about there. How did the businesses do for the quarter and the year?
So the healthcare sector, boy, I tell you, it's been in the last quite a while, almost probably over a year if I had to look back at the exact dates, but it hasn't really gotten a lot of love from the marketplace. Especially in the U.S. Canada is very thin in healthcare. We don't have a ton of really, really, world-class companies on the healthcare side. So most of this conversation will probably deal with the U.S. side of things. But that space in the U.S. for the quarter had a little bit stronger earnings growth rate than we saw from the staples. The group came in around 13% for the quarter and finished the year at about plus 4.3 for the full year. And so if we drill that down, then comparing that to our picks, and not unlike the staples sector, we have a good collection of diversified companies here, not just one particular subsector, everything from health insurers to drug companies, to equipment suppliers, these kinds of things. So well diversified there. But the growth rate from our companies and earnings was probably around 12%. And that's quite a difference, though. We had some plus 28s and a plus 2 and a minus 10. So it was a little bit all over the place in terms of the individual companies. But it did average out not too terribly far off from what the sector performed at in terms of earnings growth.
Okay. And in terms of the market reaction to that then?
Yeah, it all depended on the company. I tell you, generally this space has been under pressure. Normally when we have a change in administration towards a Republican party, it can tend to favor the regulatory environment and those kinds of things. But this time around, with sort of, let's say, cost-cutting overhang fears and budgetary constraints and these kinds of things in the U.S., the healthcare sector just really hasn't participated the way you would normally expect with a Republican party. But it's early days, and I can say the multiples are pretty attractive here, like the actual just valuations in this space, because they've been left behind. There are some pretty good candidates under the hood here, very high ROE businesses that are trading at reasonable multiples. So it's great fodder for opportunities for us.
Okay. Well, that's good to hear. So obviously every one of the podcasts can't help ourselves. We've got a looming threat and possible execution on the tariff front. Any thoughts, observations in terms of the threats of tariffs with respect to either of these two sectors?
Yeah, maybe I'll start in healthcare. When you listen to the calls, management teams are also, dealing with the changing environment as best they can and trying to make estimates on the impacts and consequences. I can say all our companies are large in size and have been through a great deal of problems in their past that they've been able to successfully overcome. So the long-term, let's say, thesis on most of the companies hasn't really changed dramatically because of the tariffs. Healthcare is one of the least, in terms of the overall sector, the company that has the least exposure to foreign sales. They do depend a lot on the domestic economy. So that is a little bit, let's say, more insulated than some of the other companies that have more sales outside of the U.S. That's not true in every company's case, but on the sector on average, that would be true. And most of the companies, when we look through the quarters, you're talking somewhere between, say, 1% to 5% potential negative impact on earnings, but it is pretty early days to see how this will flow through the earnings side of things for the companies. Consumer staples, on the other hand, a little bit more exposure to international sales and global sales, but still compared to the other 10 sectors, less than average.
Okay.
So the U.S. consumer is still a very important, let's say, component of their sales.
All right. Looking forward, other than tariffs, any other headwinds or tailwinds that you're watching for?
Yeah, when you take most of the time, we take quite a long-term perspective when we make our choices to buy and hold a company. And so some of the fundamental characteristics, in spite of the shorter term movements that are much harder to predict, we focus a lot on the longer term characteristics and attributes of the companies. And so that's what we really look for, material changes there before we would make a big, let's say, bet against or bet for a company. Even just to take a couple simple metrics like return on equity, in the healthcare side, like our average return on equity there, 44%. So these are very profitable companies. And what do they do with those profits? They pay dividends. The yield in this space in healthcare is about 2.2%. And they've grown their dividends over the last 5 years about 8% per year on average. So that's the kind of thing that helps, a nice yield and a dividend growth rate can help, cushion the blow, I guess, for our clients as they ride through some of the volatility we've seen lately.
Right. Okay. Good stuff. Brian, thank you for this.
Thanks for having me, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your accounting firm financial advisor. Reach out to your TriCert Investment Counsel portfolio manager. And don't hesitate to reach out to myself. Take care.